Well, thank you all for joining us here today. Pleasure to share the stage with you, Jim. I guess just to kind of, frame the discussion, just talk to us a little bit about your upbringing, a little bit about your family dynamic, and some of the enduring lessons that you learned during your most formative years.
Great, including the nuns beating the hell out of me?
Yeah,
Okay.
Definitely get into that.
Yeah. I grew up in the north end of Boston, about a block away from the Boston Garden. Lived there till I was about 11. Had a great mother and father. My mother's still alive, 91. Sent me a picture of her doing a plank the other day for 90 seconds.
Amazing.
Got up on the video and gave me the finger and said, "Do that." I declined. Dad passed away about 15 years ago. Great guy. He was an orphan, oldest of 6 when his mother died. At 8 years old, started working at 8. With the 10th grade education, actually ended up running the laboratories at Polaroid, which comes back into, a little into the upbringing and the story. Moved out to Stoneham after 6 years with the nuns in the North End. And we moved out there because the North End and parts of Boston, the drugs were coming in, the crime was coming in. It used to be in Boston, as an example, you stayed in your own neighborhood and you policed your own. But then some of the younger kids started getting in trouble within the old neighborhood, stealing from people in the neighborhood. And we ended up moving out, going to Stoneham, went to UMass, probably first of my generation to go to college, graduated from UMass. In the summers, I had worked at Polaroid as a security guard, and in Cambridge, in the areas where like MIT Media Lab and everything was, were the old projects. I mean, it was crazy. The midnight shift was just gunshots all over the place. And I worked in the fruit terminals in Chelsea to try and pay for college from 4 in the morning till about 2. Graduate from UMass. The only place I applied to was Polaroid. I wanted to work there when, back in 1979, it actually was a very relevant company, and I get a ding letter. And, can't figure out how I didn't possibly get the job. Dad's working there, I'm working there, knew a lot of people there. And my father just says to me, I don't know why you didn't get it, I'll figure it out, but you should go back to school. And I'm like, school? I hated school. I was always someone who wasn't great at listening and lectures and school, but I always was someone who liked to read, and so my education was really at that point from reading. To this day, I think on average in the last 35 years, I think I've bought 11 or 12 books per week. I just love reading everything, so everything was sort of self-taught. So I'm trying to figure out, I'm building tennis courts and sports courts, and I finally get lucky and I get into Northeastern's MBA intern program in 1980. And that program at the time was, I think, about 50 students, 6 months of school, 6 months of work, internship, and then 9 months of school again. And there was one professor there that actually really changed my life, and it's probably the only name of a professor I remember since 5th grade. And that was a Professor Mopples, who died a few years ago. And he taught accounting in the case methodology. So, and that was when I went back after my internship. I was going to be a CPA. I thought I was going to be a CTA, so I get a job at Texas Instruments in cost accounting. And after 2 months, I'm like, there is no way I'm doing this month after month after month. And I got lucky with Mopples, and he taught 2 courses in the case method, and then I got a part-time job. There were jobs posted at Northeastern. I worked for a small investment company called Trustee and Investors, which managed about $80 million at the time or so. And
at the time, did Northeastern have the co-op program?
1981.
Did it have the co-op program when you were there?
No. Oh, God, he was a psychopath. It was, I don't even know why it was posted up there. I mean, that's a whole nother story we can get to on that. So I ended up staying there for a couple of years. He promised me that he would give me a piece of the business, meaning some profits if I brought in money. And he taught me a lot, though. I learned how to do the taxes, back office stuff, learned how to trade, all of these things in 1981, 82. In 1982, the market started going up, and I got lucky, and I brought in almost $500 million worth of new business on 80 million. I remember my first account was with Armand Hammer, if anybody remembers him, from Occidental Petroleum. And there's a board meeting, and I'm out in California, and I'm giving a presentation, and I thought I knew everything, and I didn't know shit. Like, I didn't know anything at the time. And the whole board finally says, we'll give you $5 million, and now we're going to have dinner. They let me stay at the board meeting. And I was so naive that they were handing out cigars after the dinner, and I'm watching them cut cigars, and I'm like, what are they doing?
Yeah.
I thought you just
put it,
bite it.
Yeah.
You know, I remember one of the waiters coming over and going, let me handle that, sir. And, you know, takes care of me, and always never forget him. So anyways, I leave, I go to a place, Essex Investment, Joe McNay, who some of you might know if you're from Boston. And I worked there for a while, and I started running hedge fund money, which was called limited partnership money, back in 1986. And it's now 1989. I'd been running a few $100 million, as it turned out. And we had been compounding at a pretty good rate, somewhere around 35, 40% for those 3-4 years. And I walk into a restaurant in Boston, and the guy who dinged me at Polaroid in 1979 is standing at the bar. And you got my accent, right, the bar. And he says, Jimmy, it's so great to see you. I can't believe it. Your dad told me you're doing so well. Come on over here, let's have a drink. And I'm looking at him like, you know, like, and finally after 10 minutes, I said to him, you know, Bob, can I ask you a question? And he said, yeah, sure. He said, what? I said, how come I didn't get the job? And he said, seriously? I said, yeah, I'm just curious. And he said, you don't know? And I said, I don't know what? He said, your father told me if I hire you, he would break my legs and split my head open. And my father never told me that. I mean, I said, what? He said, your father didn't want you to be like him. And if you started making some money, he said, you'll hang out with your friends around the street, you'd never go back to school, and you'd be something like what he was, working hard and maybe not making that much money, you know, and working a second and third job, which he did too. So whatever success I've had, I mean, obviously you have your own hard work and you get your luck and stuff, but, you know, it was my father not wanting me to be anything like what he perceived to be, you know, not a great success, but to, you know, many people, he pretty much was.
I was going to say, I mean, that seems like it's a blessing in disguise that you didn't
100%.
have the opportunity to go to Polaroid. So I guess touch on a little bit of the Essex years. You were there for about 10 years.
Yep.
Talk about some of the career development opportunities that you got there and how you made the transition from Essex to eventually going to Tudor.
So we'll go back 1 second to when I was a trustee and investor. So I'm 24 years old, and remember I said I brought in about $500 million worth of new business that year, and at the end of the year, the way it was set up, what he had told me, I was going to be 24 years old and getting a check for $1.2 million. And he gave me a check for $5,000. And I remember calling my friends, going down the Cape, spending all of it, because I decided I wasn't going to stay there. I got lucky. I applied to 2 places, Home & Jordan and Essex. Jerry Jordan said, we don't have anything. Joe said, come on in, let's talk. I got the job with them. I think I'm a hot shit. I go in there, and after a week with the 4 partners, I'm like, I'm dead. I mean, the 4 partners there, Wally Wadman, Ted Duncan, Mike Hazard, and Joe McNay were really, really, really talented and smart investment people. So I'm at Essex, and I realized, like, I got to do something different, because they wouldn't answer any question I asked them during the week. You know, market opens at 9:30, I think at the time, closing at 4. They're like, don't bother me, don't bother me, don't bother me. So I started going in every Saturday and Sunday at 7 in the morning and stayed till noon to try and learn. And invariably, every Saturday or Sunday, one of the partners would come in, they'd see me there, and when I had the questions on how do you analyze this company, or how do you look at Sally Mae, or how do you look at this thing, they would take the time and help me, because I guess I was putting the effort in the same time. So I'm at Essex from 19 '83 to March of '83 to June, I think it was, of 2003. And it sort of was kind of the same thing in a way. Had learned a lot, an awful lot, traveled all over the world. You know, I remember going to London when I was like 27, 28, and you know, London was not a great city at that time, and going to Dublin. I mean, London, you either had Indian food, Mr. Chow's, Le Gavroche, or McDonald's. That was the entire, you know, and if you stayed at Claridge's, the food service, you know, room service was dog food basically. I mean, it was just horrible. It just, once the River Cafe opened, it became a completely different place. So I did get a lot of experience at Essex. It was early 1982, and my partner said, let's go have dinner at the country club. And said, great. And he said, listen, I think you should get a percentage of the profits from the hedge fund that I was running, which at the time in 1992, I was running about $1 billion, which was a large hedge fund back in 92. I mean, there were only like 4 hedge funds in the equity market that were that size. And he says to me, I want you to have 35% of the profits. And I said, that's too much. I was negotiating down. And
Why do you think it was too much?
Because it was. I said, I'll take 25% and then keep that 10% pool for analysts that work specifically on the team, on the hedge fund. And let's, you know, we have a jump ball on that 10%, do it that way. And we went back and forth and we settled on 30 finally. And then the end of the year, you know, we have a good year. And I walk in to get my bonus, and it was 20% of what I was supposed to get. And I said, what happened? He goes, well, we didn't really, you know, agree on it. I said, we shook hands.
Right.
You know, and that was the second lesson that I learned. And at that point, I was lucky enough that I could have worked with Druckenmiller at Soros, but I didn't want to work with George, with Julian Robinson, who had wanted me to come. And I met Paul, and we hit it off, and we just thought about risk and everything the same way. And he said, I can live wherever I want. I actually was running, at that time, about 1.3 billion, and Paul was running at Tudor about $1 billion. So I was managing more. He said, you can live where you want. I wanted to stay in Boston because I had made my father retire at 55 because he had worked, you know, since he was 8. And my mother and father wanted my 2 boys every day, basically, you know. So I didn't want to take them away from them. So stayed in Boston and joined Paul in 1993 and was there for 16 years.
Wow.
Yeah. But the Essex days were, I mean, you know, they were great teaching years. I mean, it was an amazing, talented group of partners in the place.
Sure. Now talk about a little bit more about the transition to Tudor. You know, what were some of the challenges that you may have faced going from Essex, kind of you understand that business model, you understand that corporation, now you're going to a new place. Were you able to, you know, kind of put your cultural stamp on the Tudor organization? Did you have any other challenges that you faced when making the transition?
You know, I ran my group 100% the way I wanted to. You know, I was the second largest, within a couple of years, I was the second largest owner of the firm after Paul.
Wow.
I did whatever I wanted with the equity side. I built out the seeding business, so we seeded people like Two Sigma and Graham Capital, Kenny Trope, and about 8 others. And we started the venture business in 1995. But I essentially was hands-off with Paul. The culture was great. I mean, it took me 9 months to decide to go, because I didn't want, if I was going to make a change from Essex, I wanted it to be the last change that I made. And I remember at least 5 times, Paul and Mark Dalton and some of the other partners, I would take them out and get them as drunk as I possibly could. Because I really wanted to see how they acted when they were drunk. I mean, one of the ways I interview people today is not to get them shit-faced, but, you know, but I look, if I go and I'm interviewing someone and I go to a restaurant or a hotel restaurant, I want to see how they treat waiters, waitresses, doormen, bartenders, taxi drivers, all that type of stuff. And if I see any sign of them not treating those people well, I don't care what amount of money they might have made our firm. It's just like, it's over. Don't want to have anything to do with that. So, you know, on a senior level, you know, On a senior level, it was kind of easy to take them out and get them, and they were the same. You know, they could be drunk, and they treated people so well. I mean, if anybody knows Paul Tudor Jones, he's one of the most charitable people, and the whole firm was incredibly charitable. He started something called Robin Hood way back when. That, if you don't know Robin Hood, we have one dinner. I was involved for a long time, and that dinner once a year raises between $80 and $100 million at that dinner for inner city programs. And the board of directors of Robin Hood, of which there's a couple hundred people working, pay 100% of all the expense of the organization and the foundation the entire year. So everything that's raised in every event that they do goes 100% into educational and inner city programs, primarily in New York City. Mm-hmm. Yeah. So had a great time. You know, 25 years of managing a hedge fund. I had compounded at about 18% after fees over that time period. Wow. I turned 50 and I was burnt out of, right. You know, I think there were so many vacations that I had canceled because all of a sudden you're going to here or there and the markets go like this and, oh, I can't go on vacation, you take the kids. And I was just tired of that type of stupidity.
Yeah. And during your time at Tudor, you had, you know, a fair share of pretty dynamic events that happened in the, you know, the broader markets, right? You had 9/11, you had, you know, low interest rates that the Fed set, you had the boom in China, you had, you know, a bunch of things that you had to deal with. How did you navigate that dynamic landscape, one? And then what advice would you give to investors today that are, you know, dealing with things that are comparable?
Yeah, I mean, the business changed a lot over when I first started running money. There weren't that many hedge funds. I was known as a good short seller. That became much, much more difficult. The largest two short-only research houses I actually had put into business, because there's always a lot of fraudulent companies that shouldn't be around. Frankly, my accounting background from Northeastern is what made me a good short seller, because you always found it on the balance sheets of which company might be a fraud or just was having some problems. We never used really leverage.
Sure.
You know, at the most was 150. I think what's happened with a lot of these funds in the last 10 years, they look like they have good performance. They're up 30, 35%. And the client doesn't realize that they're 5 and 7 times leveraged. No. And when stuff goes the other way, it just like rapidly, you know, you're down 30, 40, 50, 60% type of thing like that. So we never used leverage. I don't know. I mean, there's a lot of things I do really probably very, very bad. It was just, that was the one thing that I found my calling or something like that. Sure. And I just had common sense as well as on risk management. I mean, we never really had drawdowns more. I think we had drawdowns once of 7%. You know, that was about it.
And what time period was that?
That was near the end.
What caused that? Okay.
That was
so around 08 financial crisis?
Yeah.
Got it. Yeah. And I guess, so around 2000, early 2000s, you bought your interests in the Boston Celtics, and, you know, we have to cover sports at some point in time.
2003.
2003,
yep.
Right. For those of you that don't know, that's kind of my primary business. I bought a private equity firm that invests in primarily NBA franchises.
Tries not to overpay these stupid prices right now.
Yeah, that's right. That's right. And we were speaking about that.
We're talking about that.
Yeah, the Celtics are, you know, the controlling ownership group. They want to go ahead and sell. They're seeking a $6+ billion valuation. Jim and I both think it's a little bit too high, but we'll see what ultimately happens. But during your time there, I mean, you're a Boston, you know, born and bred. Was that like a lifelong dream for you? How would you compare?
I don't think it ever was a dream, because I never would have dreamed.
How did the opportunity present itself?
So I had earlier, here's a funny story, quick one. I had earlier looked at the Red Sox with Joe O'Donnell, who, you know, a few of you probably know in here. He was a great guy and a great friend. And he was with Steve Kopp and Joe, and they were the forward faces of trying to buy the Red Sox. And the Red Sox also owned Nesson. 75% of Nesson was that's the Super Channel, or the station. Nesson was 75% owned by the Celtics, not the Celtics, the Red Sox, and 25% by the Bruins. And so we had a good bid in, and then a week before, Aramark signed a 7-year deal with Harrington, who did not like Joe O'Donnell, for concessions. And Joe had a concessions business. And Joe calls me up and he's like, Jim, we're out. I'm like, what are you talking about? He goes, they signed with Aramark. I go, it's not about the hot dogs. Like, it's about the media, which was, I started out as a media and entertainment analyst in 1983. So a lot of my background was media and technology going way, way back. Not as good in technology as Rich was, but I was better than him in media, I think. So it was all about the media because at the same time, I had a deal where a friend of mine was the president of the Celtics. The Celtics were owned by a New York group. It was Paul Gaston. His father had owned it, Don Gaston, who was part of old Gulf and Western. And I could have bought the Celtics because he wanted to sell it with no one knowing. And so what I wanted to do is have the Red Sox, the Bruins, and then after the TV contract on the Celtics run out, you put the Celtics on NESN, and you have the ultimate superstation in the entire country. Because the Red Sox and the Celtics were always the number 1 or 2 team on the road. I mean, it was amazing. If you went to Oklahoma City to see a basketball game, a third of the place would be in Celtics jerseys. It didn't matter. So it would have been great, but that blew up. So I forgot about buying the Celtics. A couple of years later, Wick and Pallotta come to me and say, we'd love you to be part of our group of the 3 to be the primary owners of the Celtics. And I thought about it and I said, I was the second largest owner for that time period. I said, I'll do that, but I'll go on the board, but I can't be one of the faces because at that time, nobody in the financial industry and hedge funds was owning teams. Right. So the first thing they would have said is he's not caring about his hedge fund and his fund, he's worrying about the Celtics. So I said, I'll do it, but I'll spend more time from the basketball side with Danny Ainge and that group. So that's how I ended up with the Celtics. And I remember when we closed that day, I got interviewed by a woman on CBS, something like that. And when I was a kid, there were 6 or 7 or 8 of us. We would each pitch in a dime or a quarter and buy 1 ticket for the Celtics game. And one would go in the front, and the rest of us in the old garden would climb up the fire escape. And he'd go in, and he'd open the door in the top, and he'd, just a fire drill. And they didn't care up there. The ushers could care less. I mean, they couldn't even find us, because back then you could smoke, and the entire third balcony was just fog. I mean, it was crazy to think that that's the way it used to be. And then when I got out of college, before I went to Northeastern, I had 0 money, living with 4 guys. But my 3 good friends from South Boston had a machine that made fake tickets. So from 1980 to 88, I went to basically every game and stood in section 86 and 88 with Michael Haley and Joe Scully and Tom Swiderski. And I remember getting interviewed, and the woman said, you grew up 1 block away. How does it feel like being an owner of the Boston Celtics? And I remember saying, it's just great going in the front door. And she had no idea what I was talking about. Yeah, but about 500 people in Boston knew, that's what I had been doing for a long time.
And now, how does your return on the Celtics investment compare to, your years at Essex and Tudor?
I think if at Essex, if you work out the numbers at 18% net or so, if you take those 25 years, I think if you gave me $1 million at the beginning, I think it turned out to somewhere over $100+ million, right? In the Celtics case, on a tax-adjusted basis, because I offset some losses I had from my fun in Rome, probably about 22 times it went up from that period. So it was a great investment for sure then, but we didn't really, none of us thought that the valuations of the sports teams would go crazy, especially when you take NBA basketball. The TV contracts keep getting higher, yet the viewership numbers keep going down every single year. Yeah. That's just not what you would learn in economics, right?
Yeah. No, totally. So you leave Tudor. In 2009, you start to focus more on the Raptor group.
Yeah, Raptor was my fund.
That was part of it.
That was the fund. It was called Raptor, and all I did was start a family office and kept the name Raptor.
Got it. So, but now you're focused mostly on private investments, not necessarily public equities?
I trade public equities, but I don't trade outside money. Public.
Got it.
Right.
Got it.
And we do a lot of venture. We do some real estate. We do whatever we think
Got it.
could not lose money.
So could you talk a little bit about, your corporate vision for Raptor and, your investment philosophy? Because it seems like you're industry agnostic. You have, investments across multiple industries. Could you talk a little bit about that?
Yeah, I think we tend, as a family office, you tend to, or should, probably have a much, much longer term view
Sure.
of how you're investing than you do as running an investment company with public money or running a hedge fund. And while I think they should be run the same, the clients and the institutions, always like, how did you do this month and how did you do this quarter? And it's just a lousy way to manage money. In a family office format, you can sit there and go, okay, I think this starts at 10, and I think in 5 years, if this works out the way I think it is, it's 50, and I don't worry if it goes to 35 and then comes back to 20
Sure.
and that type of thing like that. But you really couldn't do that after a while if you had money from institutions.
Right.
I mean, it was crazy. I remember at one point near the end, I think I was running somewhere around maybe 3 years before I left, $8 or $9 billion, and the market got smoked. And I got a call from a client, and he said, "You must have got killed today." And I said, "No, we're hedged, and we really have like about, we have a lot of cash. I mean, we just happen to have a ton of cash, like probably 80% of the time in cash." And then 2 days later, the market rocketed, and the same guy called me up, and he goes, "You must have killed it today." I go, "Yeah, because I put $8 billion to work yesterday." I'm like, "What are you talking about?" This is like, it was just it just got tiring the way the institutional money and people looked at it.
Sure.
And so in a family office, all of the stuff we tend to do is, over years.
Sure.
Is how we look at things.
Different time horizon.
Yeah, much different time frame.
So in 2009, you focus on Raptor kind of exclusively.
Well, 2010, set up the family office.
Yep.
We have about 18 people in it in Boston, a few people in Charleston. We have an office 1 block from here, which is great, not a long walk, with about 6 people here also.
Yep.
And so the last 15, 16 years, it's been that.
Sure.
We had the Celtics, and then, I had to stop briefly when I had to take over his fault, Rich's.
Yeah.
I had to take over as president of Roma and deal with that for about 9 years.
Got it.
So,
Got it.
Yeah.
So now, back then, there were some pretty compelling investment opportunities. What do you think are, pretty compelling now as you think about the technological advancements that we're seeing in the broader markets?
Yeah. I mean, I think there's always great investment opportunities. And, again, part of it goes back to what I said of like, what's your time frame, right? I mean, if you look at companies like even an Uber and you say, oh God, it looks expensive to me, but Dara's come in there, Khosrow Shahi done a great job, and he's starting to generate 4, 5, 6 billion of cash, and there's a whole bunch of other things going on. And if you look out 5 years, something like that could be a triple or more, because every free cash, every dollar that they're getting in a free cash flow, they're buying back stock.
Sure.
So I mean, it depends on your time frame. But if you said today, oh, I think Uber's like a great buy today for the next month, probably not. Right. So I always think there's great investments. One of the things we're doing now, where we are taking and doing outside money in certain areas, and I've seeded a few other businesses and funds, is about 3 years ago, I thought that semiconductors are the most strategic asset that the United States has. It's not energy. You can get energy anywhere. It's the intellectual capabilities that are coming out of places like Northeastern, where we've seeded some companies, or Stanford, or MIT, or just people leaving other semiconductor companies. And if you can see with what's gone on with China as an example of trying not to let them have any chips. But the U.S. has the best intellectual capabilities in semiconductors, whether it's Cadence or Synopsys or Mentor Graphics, which are EDA, electronic design automation companies, or ASM Lithography, which is a Danish company or a Denmark company, but it's essentially a U.S. company, because they're telling them you can't sell to these people or those people. So there's a lot going on in the semiconductor industry, and what we did is we put together what I think by far is the best team in the world, and it's getting proven out already, is I brought in an old partner who's been covering semis and technology, telecom for 25 years, Rob Brogy. And then we identified a third partner who took a technology out of Northeastern, went to Northeastern. His name is Greg Waters. He was at Texas Instruments. He ran part of Skyworks. Then we invested in a company in a while back called IDT that he ended up selling for $7 billion. And now is running this very, very cool company called Matrix Space with technology out of Northeastern that Northeastern owns a piece of too. And he's my third partner. And then my fourth partner is a guy, Rick Clemmer. And Clemmer was a senior position at Texas Instruments. Then he took over NXP and he took it from $1 billion to $50 billion market cap. And so he's the fourth partner. And then we said, let's get 5 strategic semiconductor companies in different verticals to be our first investors. And that's like Global Foundries, ARM Holdings, Analog Devices up in Boston, Nextera. And then we brought on about 16 of the top people in the world as advisors. And so there isn't a team like that anywhere in the world. So we're raising a fund. We did 1 close of 80. We'll raise 350, I think, something like that. We've done 2 deals in the fund, 6 outside of it before the fund. But I think that is one of the most attractive areas by far if you have a good team anywhere in the world for investing. And then you can see, like Saudi said, we want to spend 100 billion. UAE said we want to spend 100 billion in semiconductors. The funny thing is, you know, we're having conversations with them on some growth stuff. It's not that easy to, you know, there aren't that many people that really understand the semiconductor world in the investing side. What happened is that, and we're going to do something at Northeastern, what happened is that you lost an entire generation of engineers from like late 1990s to 2000 and say 20 that went to Snapchat or Instagram or Facebook, or they weren't doing the hard, deep tech and things that you needed in semiconductors. That's slowly starting to change, but if you look at colleges, there really aren't any great semiconductor colleges, programs in the country. Purdue talks about it, but you know, I think Northeastern has a massive opportunity that we've been working on to build out a engineering semiconductor, the leading one, I think, in the country. And I think with the relationships that Joseph and the board has overseas, we logically can help places like Saudi and UAE, or Abu Dhabi and others to educate them. They need to be educated. All of them have a copy of Chris Miller's book, Chip Wars, on their desk and think, well, now I know semiconductors. There really is a huge education process that has to take place, and you know, Northeastern has a unique opportunity to really lead that. And you know, everybody on, you know, Joseph and the others have already said that this is some area that we're going to be big in.
And for the funds that you're raising, are you primarily taking minority interest, majority interest?
Most of the stuff in venture is minority interest.
Got it. And you'll have a board seat or something like that, have some
Most
governance
of the time
rights.
they want us on the board. All the time they want us on the board, and we're getting every single deal that we want at whatever valuation because of the team, of what they can bring to the table. As an example, we just got this deal led by Google, 30 million of a 40 million deal. There were 35 big VC firms that wanted the last 10 million. We went out there, they gave us the 10 million. And then NVIDIA and Microsoft just came in for 5 more each and stuff. So now we have 2 of the 3 hyperscalers, and you know, it's that type of company. And it's all because, not because of me, because of the team that we've put together, really, really smart in that group.
And now the semis, it seems like you're buying into the picks and shovels of this kind of AI.
100%, that's what it is.
That's the way to do it. So do you have any AI exposure? Are you looking at quantum computing? How do you assess the risk of these sort of, you know, very disruptive technologies where the market adoption is unknown?
Yeah, so, you know, look, the AI side, I've been involved in that for a long period of time. I've been on MIT's artificial intelligence board with some of the smartest guys in the world, like Demas from DeepMind and Poggio and a bunch of other people like that. I think I've been on for about 9 or 10 years. And I kind of think like I'm on that particular board because they need a benchmark of somebody with less intelligence, but I'll take, I'll just kind of, I'll take it anyways on it. So I've been involved for a long, long time on what you would call AI. And, I mean, it's not like it's going away. It's whether or not at some periods there's too much fluff in some of these names.
Yep.
Tons of money being spent, and that money's going to continue to be spent. I mean, you're going to have to, data centers, the more and more data, you just need bigger and bigger and more data centers. Electricity usage, which might have been 1%, is easily going to go to 3, 4, 5% per year. So we're not even close to being able to handle that on the grid. And that's similar to what's going on in India and what's going on in China. All of that type of stuff like that is going on. So the AI piece of it, there's a lot of fluff because we get probably investment decks, I don't know, 30, 40, 50, 60, I don't even know, a week in our place. And all of a sudden, everybody's becoming an AI company.
It's like blockchain
right?
a few years ago, right?
Tequila company. We use AI to figure out who wants to get drunk. Like, it's just like it does, everybody is an AI company now. So I think where the opportunity on the AI stuff is really now what's going to become on the application side,
Sure. Yep.
right? And there's a lot of interesting stuff. We have a couple of companies that we own that we love. One just got published in Nature magazine actually today, really,
Sure.
really super one. I think Dario Villani. And then, and the quantum computing side, I think that's way, way, way away. The applications are just not even close to there. You can do a lot of stuff on classical computing, what would be the equivalent of qubits of like 4 versus IBM's at 200 today. There's just no usage of it when you can do it on a classical still to this day. The way I look at quantum computing, it's like if I had a 45-foot boat with 40,000 horsepower behind it and engines, what the hell am I going to do with it? There's no place to like go.
Right.
You can't go that fast. It's just not necessary. It'll be someday,
Sure.
but we don't focus on anything to do with quantum. It's just so far away.
Sure. For these like AI startups, what are some of the fundamental characteristics that you look for before making an investment?
Oh, God. I mean, the team is so important in that case.
Sure.
Of their
Are you looking for like number of
backgrounds in
PhDs
this,
and that sort of
and
thing?
the engineering.
Sure.
And even with that, you've got to be unbelievably careful. But I have a bunch of good friends around the world who are really talented, and they help me analyze it because I can't. And I'll give you an example. There's a company that just raised money at $5.5 billion. That was a spin out of Google. And Eric Schmidt was involved on it as chairman, and they're trying to raise $500 million. And I'm going through the deck, and they're in this area in drug discovery, they're in this thing in radar, they're in this thing in this, and I'm reading it, and it just seemed strange, but I just couldn't make the call on it. And a lot of people were putting money into this, and I had the #1 materials guy in the world as an advisor, and then Dario, who has an AI company. And we got 7 of their top scientists on the phone, and 5 of them wanted just to meet this guy, Nicola Mazzari, who's the best in the world, who's about to become the head of Cavendish Chair at Cambridge, which only 9 people in history have ever gotten, starting out with James Maxwell. So he's a very talented guy, maybe the best in the world. And within 30 minutes, he got them to admit that they don't have anything. They hope that they can do this in radar. They hope that they can do this in drug discovery. They hope they can do that, but they don't have anything. And they raised money at $5.5 billion, which was insane. And so you have to be really, really careful. And I can tell you, even though I've been involved for a long time, I know this versus the people I would have help me.
Sure.
You can easily get burnt in this area. There's going to be a lot of pain in this one.
Yep. And I guess, you guys have had some pretty successful exits in terms of, IPOs, strategic buyers coming in to buy the companies that you've invested in. Can you talk a little bit about what you look for in terms of underlying characteristics for companies that are well suited for the public markets or well suited to be potentially acquired by a strategic buyer down the road?
We try to, and I don't think we get it right, all the time, and a lot of times wrong. We try to, when we look at something, say, who is this potential strategic buyer, and or can this company go public, right? And many times you think, yeah, this one can, and then a year later you go, nope. Sometimes it's the most unlikely one. So if anyone says that they have, the blueprint of it,
Sure.
I mean, if you look even, I think, Rich, in the Sequoia fund that had Facebook in it, right? I think they had 28 positions in that portfolio, and I think the only one that worked out might have been Facebook. One of those big venture firms, like the only one that they had that worked out, and they're supposed to be, some of the best people in venture land. In the semiconductor stuff, we don't look for science projects, right? In the semiconductor side, we're looking at things that are either taped out, ready to go, or about to, and that the exits are going to be somewhere between 2 to 4 years. We're not looking at a fund that's going to have 8 years or 10 years in it. So on the first company that we just did, as an example, Ethanovia competes against the company Broadcom and Marvel. We thought they were 2.5 years ahead, but 15 months ago when they came to us and were raising money at 250 million, 30 million, we said, if you can pull it off, it'd be great, but we don't know that you can, so we're not investing now. If you do pull it off and tape out, we'll come back and we'll do the next round, right? And so 3 months ago, they came to us and said, it works. So we went in there, it works.
Sure.
We said, when's the next round? They said, we need you guys so badly, we kept 10 million of the 30 for you guys to come in at that valuation. And then 1 month later, they got their first $100 million contract that could be worth up to $2.5 billion. And now they're doing their next raise at 3 times what we put in, only because of the team that we had. But in that case, Ethanovia has 2 exits, 3 exits. Broadcom or Marvel is going to have to make a bid for them at some point. Broadcom's a $1 trillion market cap. Marvel's pretty significant too. Or this is a management team that's done it before, and they're 100% a team that can go public. And I think in this case, we'd probably rather them go public because they could become a 10, 20, $30 billion company with some work. Yeah.
And in that case, would you stay in touch with the folks at Broadcom to kind of see if they have any interest in acquiring a company like this? Or do you just assume that that's something that they'd like to?
At some point when we say we got to do something, or unless they make a preemptive, my guys all know who the players are in semi-land, and we know all the bankers because of 30 years, 40 years of experience in it. So, there are some times where there's a couple of our companies right now where we don't know that they're going to make it the way we would have liked them to make it, and that we're already looking at M&A activity to, like, this fits in perfectly with you. And, we don't think it's going to be a 10 or 20 bag, or we might get our money back or make a little money.